Thanks to all who have joined us by WebEx for standing by. Welcome to the open meeting of the Public Company Accounting Oversight Board. During the meeting, you will be in listen-only mode. As a reminder, this meeting is being recorded and a recording is expected to be made available on the PCAOB's website. I would now like to turn to Chair Williams to formally convene the meeting.
Good afternoon and welcome, everyone. This is an open meeting of the Public Company Accounting Oversight Board on April 9th, 2024. We welcome those of you who have joined us today by webcast or dialing into the teleconference. Before we proceed with the agenda, I will note for the record that all board members are participating in this meeting and we are able to hear one another. The first order of business before the board today is a staff recommendation that the board propose for public comment amendments to its rules and reporting forms to require the reporting of specified firm-level metrics on a new Form FM and specified engagement level metrics on an amended and renamed Form AP, Audit Participants and Metrics. To present the staff's recommendation, I will turn to our Chief Auditor, Barbara Vanich.
Thank you. Good afternoon, Chair Williams and board members Ho, Stein, Thompson, and Bodick. The Office of the Chief Auditor is pleased to recommend that the board issue a proposal for comment that would require certain registered public accounting firms to publicly report specified firm and engagement level metrics relating to their audits and their audit practices. This proposal draws on input from numerous sources, including the recommendations of the U.S. Department of Treasury's Advisory Committee on the Auditing Profession as set forth in their 2008 final report, the board's 2015 concept release on audit quality indicators and the related comments received, current practices of firms, recommendations from the PCAOB's Investor Advisory Group, and the initiatives of regulators in other jurisdictions. The staff have carefully considered this input in developing the proposal before you and believe that it strikes an appropriate balance between the expected benefits of new reporting requirements and the associated costs of implementation and compliance. Some firms already publicly disclose certain firm-level metrics through audit quality or other similar documents. However, the disclosures are inconsistent across firms, and currently there are no common definitions or calculations allowing for consistent comparisons. Moreover, most of the disclosures are voluntary, so firms are free to revise or discontinue this reporting at any time. This voluntary reporting regime does not provide consistent, comparable information that stakeholders can rely on to inform their decisions over time. In the board's initial efforts to explore firm and engagement level metrics, in the early concept release, we referred to audit quality indicators or AQIs. This proposal quite deliberately does not. The new term firm and engagement metrics avoids the potential misimpression that any set of metrics can comprehensively measure audit quality. Some of the most important elements of a high-quality audit, such as the application of due care and professional skepticism, cannot be measured and quantified directly. While no set of metrics can comprehensively measure audit quality, we believe the metrics we are recommending, in combination, analyzed across firms and over time, would provide important, actionable, currently unavailable information that would empower investors, audit committees, and other stakeholders. Public reporting of standardized firm and engagement level metrics could create a useful data set available to investors and other stakeholders for analysis and comparison. Additionally, this information could be beneficial to firms in evaluating their audit practice and related system of quality control. The proposal envisions that reporting would be required in situations where we believe that additional perspectives about the audit and the auditor would be most likely to inform the investment and proxy voting decisions that investors are called upon to make. Firm-level reporting would be required for every firm that audits at least one accelerated filer or large accelerated filer, as those terms are defined in SEC rules. Engagement level reporting would be required for every audit of an accelerated or large accelerated filer. Stephanie Hunter, Claire Sever, and Akiko Upchurch will discuss the background and provide an overview of the metrics and reporting of the metrics. But before I turn the floor over to Stephanie, I would like to acknowledge the many people within the PCAOB who provided significant contributions to this project. First, I would like to express my sincere appreciation to Jessica Watts, Karen Wiedemann, Stephanie Hunter, Claire Sever, Akiko Upchurch, and Skylar Sims from the Office of the Chief Auditor, the team that led this project. I would also like to thank our colleagues from other divisions for their significant contributions, in particular Martin Schmalz, Nick Galunik, and Jonathan Fluarty JD in the Office of Economic and Risk Analysis. Connor Rasso, Catherine Kelly, Vince Meehan, and Mark Francis in the Office of the General Counsel, the Division of Registration and Inspections, and the Division of Enforcement and Investigations. Finally, I would like to thank the staff of the Securities and Exchange Commission for their support and timely assistance with the project. With that, I'll turn it over to Stephanie.
Thanks, Barb. We believe the metrics we are recommending would provide valuable additional information, context, and perspective about auditors and audit engagements, which could be used by investors, audit committees, and other stakeholders. This would advance investor protection and promote the public interest by enabling stakeholders to make better informed decisions and promoting auditor accountability. Today, investors and audit committees cannot easily observe the services performed by auditors. This can limit investors' ability to make informed decisions about investing their capital, ratifying the selection of auditors, and voting for members of the board of directors, including directors who serve on the audit committee, and audit committee's ability to choose among and monitor the performance of auditors. At the same time, there is a lack of incentive for firms, in the absence of regulation, to provide accurate, standardized, and decision-relevant information about their firms and the engagements they perform. In response to these challenges, the board has studied ways to measure audit firm and audit engagement performance, primarily with a view to providing information useful to investors in their investment and proxy voting decisions, but also recognizing that metrics could potentially be informative to others. The information provided by the metrics would increase the set of information available to investors and audit committees regarding their auditor's performance and reduce costs incurred by investors and audit committees to gather information about their auditors. This would improve both investors and audit committees' ability to monitor their auditors. For example, an audit committee could engage in more meaningful discussions with their auditor regarding the auditor's performance and potential future work. While audit committees may already have some information about their auditor or their audit, they do not receive the information in a standardized form or have information from other firms or similar engagements that enables them to compare their audit and their auditor with others. With access to such information, audit committees would have new tools to use in selecting auditors and monitoring their work. We are recommending reporting at both the firm and engagement levels. Firm level metrics would relate to aspects of the firm's audit practice, and engagement level metrics would relate to individual audit engagements. The firm level metrics could provide information relevant to the firm that could be beneficial in providing context for engagement level metrics and in evaluating the firm's audit practice and its related system of quality control. The engagement level metrics could provide information relevant to an audit engagement that could be useful in gaining a richer understanding of a particular audit. Most metrics would be reported at both the firm and engagement level, but for some metrics, there would be reporting at only one level. The proposed firm level metrics would be filed with the PCAOB on a new Form FM, firm metrics, and engagement level metrics would be filed with the PCAOB on a revised and renamed Form AP, audit participants and metrics. Now, to provide you with an overview of the proposal's firm and engagement level metrics, I am turning this presentation over to Claire Saber.
Thanks, Stephanie. The firm level and engagement level metrics are in 11 areas. Most metrics would be reported at both the firm and engagement level, but for some, our recommendation is for reporting at only one level. As discussed earlier, one of the objectives of the draft proposal before you is to provide consistency and comparability across firms and engagements. In order to achieve that, for each metric, the proposal provides a description of the metric, a specified manner in which to calculate the metric, and an example calculation. In addition, the proposal includes a set of key terms and concepts used. Where practical, the key terms align with existing definitions in PCAOB standards and rules. In other cases, there is new terminology provided specifically for the metrics to foster a consistent approach to determining them. The metrics are in the following areas. Partner and manager involvement. These firm and engagement level metrics would provide the hours worked by senior professionals relative to more junior staff across the firm's issuer engagements and on the specific engagement. Workload. These metrics would capture average weekly hours worked on a quarterly basis by engagement partners and by other partners, managers, and staff. This includes time attributable to engagements, administrative duties, and all other working hours. Audit resources, uses of auditor specialists and shared service centers. At the firm level, these metrics would show the percentage of issuer engagements that used specialists and the percentage that used shared service centers. At the engagement level, these metrics would show hours provided by specialists and hours provided by shared service centers. Experience of audit personnel. These metrics would show average number of years of experience of senior professionals at public accounting firms, both firm-wide and on the specific engagement. This would include experience at both PCAOB-registered firms and unregistered firms. Industry experience of audit personnel. These metrics would show the average years of experience of senior audit professionals in relevant industries. The firm level metric focuses on key industries in the firm's audit practice, and the engagement level metric on the audited company's primary industry. Retention and tenure. These metrics would capture continuity of or changes in senior professionals through departures, reassignments, and the like, across the firm and on specific engagements. Audit hours and risk areas metric would only be reported at the engagement level and would report hours spent by senior professionals in aggregate on significant risks, critical accounting policies, and critical accounting estimates relative to the total audit hours. Allocation of audit hours. These metrics would show the percentage of hours incurred prior to and following an issuer's year-end, both across the firm's issuer engagements and on the specific engagement. The quality performance ratings and compensation metric would only be reported at the firm level and would show relative changes in partner compensation between groups of partners based on internal quality performance ratings. This would be shown as a percentage of the adjustment received by groups of partners as compared to the highest rated group. The reporting of this metric would not be required for firms that are exempt from partner rotation rules under the SEC. Audit firms' internal monitoring. At the firm level, this metric would provide the percentage of issuer engagements subject to internal monitoring and the percentage of those engagements with engagement deficiencies. At the engagement level, it would identify whether a previous engagement for the issuer was selected for monitoring in the firm's most recent internal monitoring cycle, and if so, whether there were engagement deficiencies and the nature of such deficiencies. Restatement history. At the firm level only, this metric would show restatements of financial statements and management reports on ICFR that were audited by the firm over the past 5 years. To provide you with an overview of thresholds for required reporting that we are recommending, I am now turning the presentation over to Akiko Upchurch.
Thanks, Claire. As Barb noted, we recommend that the same threshold would apply for both firm-level and engagement-level reporting. Firm-level reporting would be required for every firm that, during the reporting period, audits at least one accelerated filer or large accelerated filer, as those terms are defined in SEC rules. The determination of whether a firm was required to provide firm-level reporting would be made every 12 months as of September 30th. Engagement-level reporting would be required for every audit of an accelerated or large accelerated filer. The proposed threshold would apply to audit and auditor of companies that account for the overwhelming majority of U.S. public company market capitalization. We also believe it would capture situations where investment and proxy voting decisions would be most likely to benefit from additional information about the audit and auditor. The firm-level reporting requirements in draft proposal would apply to approximately 200 firms, including 22 of the top 25 U.S. firms by total firm revenue, and 13 of the 14 firms that were subject to annual inspection in 2022. It is estimated that the proposed engagement level reporting requirements would apply to approximately 3,400 issue audits, representing 99% of the total market capitalization of the issuers, reporting on Form 10-K, Form 20-F, and Form 40-F. We recommend applying the same threshold for firm level and engagement level reporting so that all firms that meet the proposed threshold would provide both firm level reporting and engagement level reporting on relevant engagements. This should foster comparability across both issuer engagement and firms, provide richer context in evaluating engagement level information, and would avoid the potential inefficiency associated with reporting only firm level or only engagement level information. Firms that did not meet the threshold for required firm level or engagement level reporting would not be required to report the matrix, but could choose to report voluntarily. Firms whose client portfolio changes from year to year may be required to report in some years and not others. The draft proposal contemplates that the reporting of firm-level matrix would be on a new Form FM, covering the 12 months ended September 30th in each year and required to be filed with the PCAOB by November 30th. The reporting for engagement level matrix would be in a new section of the PCAOB's existing Form AP. As a reminder, most audits, Form AP is due within 35 days after an audit report is first included in an issuer's SEC filing. Currently, the entire Form AP dataset and data dictionary are available to download in CSV format. We recommend that the Form FM dataset be made similarly downloadable. Finally, we recommend that the firm be permitted but not required to provide a brief narrative disclosure together with any or all of the firm level or engagement level metrics they report. This would give firms the ability to provide any context they thought necessary for an appropriate understanding of the reported matrix. The draft proposal provides that the optional narrative disclosure would be no more than 500 characters per matrix. I will now turn the floor over to Tian Lian, Associate Director in our Office of Economics and Risk Analysis.
Thank you, Akiko. Good afternoon, Chair Williams and board members. The Office of Economic and Risk Analysis has performed an economic analysis of the proposed amendments. The economic analysis includes establishing a baseline under today's rules, identifying a need for rulemaking, evaluating the economic impacts of the proposal, and assessing reasonable alternatives. We believe the economic analysis contained in this release even-handedly sets out the likely economic effects of the rule, and we look forward to receiving public input on the release. In particular, relevant data and analysis would be most informative to any future consideration of the proposal. I'll now turn it over to Nick Glumick, Assistant Director, Economic Analysis, to present the details of our analysis.
Thank you, Tian. Good afternoon, Chair Williams and board members. Investors and audit committees cannot easily observe the services performed by auditors. This limits their ability to assess the quality of service they are currently receiving from their auditor, as well as the quality of service they could potentially receive from an alternative auditor. As a result, their decision-making is less efficient and effective than it otherwise could be. The proposal would help address this problem by mandating public disclosure of a variety of firm and engagement level metrics. The proposed metrics would relate to various aspects of audit processes, audit outcomes, and firms' commitment to quality. By specifying how they should be calculated, the proposal would help ensure that the proposed metrics would be comparable across firms, engagements, and time. Firms could also voluntarily provide a brief narrative disclosure to help investors and audit committees accurately interpret the additional reporting. Though the proposed metrics could not be used to determine per se the quality of an individual auditor or an individual audit engagement, they would nevertheless inform investors and audit committees' decision-making. Audit committees are currently able to request and receive certain information from firms on an ad hoc basis. However, the proposed metrics would be more comparable and accessible than similar information audit committees could otherwise gather independently. We have analyzed the benefits and costs of the proposed reporting requirements. The proposal would improve audit committees' ability to monitor and select auditors, and investors' ability to make decisions about ratifying the appointment of the auditor, voting for members of the board of directors, including directors who serve on the audit committee, and allocating capital. Auditors would have an incentive to compete on the basis of the proposed metrics. These effects could improve the quality of audit services and in turn the quality of financial reporting. The proposal could also reduce costs incurred by audit committees and investors when gathering information about auditors independently. Finally, the proposal could enhance the effectiveness of PCAOB statutory oversight and scholarly auditing research. Firms may incur costs to build an appropriate reporting infrastructure or update existing infrastructure. They may also incur costs to produce the proposed metrics. For example, firms would need to gather engagement level data, make the required calculations, design and operate appropriate controls, and prepare and submit the relevant filings. Firms may need to train personnel and operate and administer their expanded reporting systems. I thank our PCAOB colleagues in the Office of the Chief Auditor, the Office of the General Counsel, the Division of Registration and Inspections, and the Division of Enforcement and Investigations, as well as SEC staff for their support in developing the economic analysis. I will now turn the floor back over to Barb Banich for the staff's recommendation.
Thank you, Nick. In closing, the staff is recommending that the board issue for public comment a proposal related to firm and engagement metrics substantially in the form before you and open the comment period for the proposal. Thank you, and we're happy to respond to questions.
Thank you, Barb, Stephanie, Claire, Akiko, Tian, and Nick. At this time, my fellow board members and I will have an opportunity to make a statement or ask questions to the staff. We will proceed in the order of seniority, and I will begin. Trust is essential to our capital markets, and transparency fuels trust. Consistent, comparable information about audit firms and the issuers they audit bolsters confidence, strengthens oversight, and empowers investors and audit committees to make more informed decisions and help drive audit quality forward. That is the goal of the two proposals before us today, beginning with firm and engagement metrics. The firm and engagement metrics proposal sets out a standardized set of 11 metric areas for every firm that audits at least one public company classified as either an accelerated filer or a large accelerated filer to disclose each year. The metrics are grounded in countless hours of research by our professional staff. They include information about firms' overall audit practice. For example, how partners' quality performance ratings affect their compensation, and information about individual engagements. For example, the time incurred by partners and managers on the engagement team related to areas of significant risks, critical accounting policies and practices, and critical accounting estimates. Collectively, these metrics would help investors make more informed decisions about how they invest their money, and they would provide audit committees with consistent data to analyze and compare as they are selecting and monitoring audit firms. Firms could use these standardized metrics about themselves and their peers to assist in designing, implementing, monitoring, and remediating their systems of quality control. The PCAOB could also benefit from having this information provided in a consistent and comparable form to use in our inspections program and standard setting initiatives. Over time, the benefits from the disclosure of these metrics would likely increase as a greater amount of information is accumulated, making trends more apparent and enabling the benchmarking of information across engagement teams and firms. Today's proposal is informed by more than a decade of careful study and collection of input from stakeholders. In 2015, the PCAOB board issued a concept release to obtain public comment on the disclosure of a proposed set of metrics related to an issuer's engagement team and the engagement team's respective audit firm. This concept release was partially spurred by a recommendation from a 2008 report issued by the U.S. Department of Treasury's Advisory Committee on the Auditing Profession. That report included suggested actions directed at the PCAOB and other organizations that would enhance the sustainability of a strong and vibrant public company auditing profession. In the last 10 years, other jurisdictions have implemented mandatory or voluntary initiatives related to the monitoring and disclosure of metrics. At the same time, most of the largest firms have voluntarily published transparency reports, including metrics of their own. But the lack of consistent standards across firms makes it difficult for stakeholders to use these metrics in a meaningful way. Over the years, our expert staff has continued to accumulate knowledge and experience with firm disclosures and metrics. And the PCAOB has heard from various stakeholders on the need for a consistent set of metrics at both the engagement and firm levels. Over the last 2 years, both our Standards and Emerging Issues Advisory Group and our Investor Advisory Group have held separate discussions where they emphasize their continued interest in firm and engagement metrics. As Barb mentioned, these metrics are not guaranteed predictors of audit quality. They do provide an important window into how a firm manages its resources and conducts its audit that, with context, will empower audit committees, boards of directors, and others to hold firms accountable. And accountability begets quality. As always, I'm interested in reading the comments received on this proposal, including those comments on the set of metrics we identified and the proposed calculations so that the metrics are consistently disclosed by all firms that would be required to comply. I would like to thank the many staff at the PCAOB for their work on this project. Specifically, I would like to thank in the Office of the Chief Auditor, Barb Vantage, Jessica Watts, Stephanie Hunter, Karen Wiedemann, Claire Sever, Skylar Sims, and Akiko Upchurch. In the Office of Economic and Risk Analysis, Martin Schmalz, Nick Galunet, and Jonathan Fluharty, JD. And in the Office of the General Counsel, Connor Rasso, Catherine Kelly, Vince Meehan, and Mark Francis. In addition, I would like to express my gratitude to my fellow board members and their staff for their contributions to this project. I would also like to recognize the support provided by the staff from the Division of Registration and Inspections and the Division of Enforcement and Investigations and the Office of Communications and Engagement. Finally, I would like to thank the Security and Exchange Commission staff, including the staff in the SEC's Office of the Chief Accountant, for their support and assistance. I will now turn to my fellow board members for any statements they may wish to make or questions they would like to pose to the staff. Board Member Ho, the floor is yours.
Thank you, Chair Williams. As a former Treasury senior executive who successfully led the government-wide implementation of the first federal open data law, which provided the public unprecedented transparency and accountability over federal spending, I am a strong advocate for and have deep experience in data transparency. I therefore support standardized reporting that is accurate, helpful, and a good fit for its proposed use, consistent with the Paperwork Reduction Act principles. The PRA principles are designed to ensure federal agencies, one, do not overwhelm the public with unnecessary or duplicative requests for information, and two, facilitate decision-making based on high-quality data. Although the PCAOB is not subject to PRA, since it is not a federal agency, the principles are relevant when evaluating this proposal, especially if we as a regulator are committed to adopting effective and responsible regulations. As such, for each of the proposed metrics, I consider the following three questions. First, will the information we are proposing to collect be accurate? Accurate information provides users facts to anchor their assessment and decision-making. I applaud the staff's thoughtful effort to identify metrics that can be derived from standardized and objective mathematical calculations. However, I am concerned about the burdensome nature of some of the metrics. For example, one of the proposed metrics is the reporting of hours spent by senior professionals on significant risks, critical accounting policies, and critical accounting estimates relative to total audit hours. Reporting this metric requires a mechanism to track hours at a granular level by specific audit areas. For large firms, this metric alone might necessitate system changes to ensure accuracy and consistency. For small and medium-sized firms, this metric may require them to implement a new system. In addition, these audit areas can overlap and may differ by issuer engagement. Therefore, this metric may present administrative challenges and distract the engagement team's focus from auditing to accurately allocating work hours across overlapping audit areas. Second, will the information we're proposing to collect be helpful to the targeted users? Our proposal makes it clear that the targeted users are investors and audit committees. Since the proposal stated that no one set of metrics can comprehensively measure audit quality, putting metrics into context is crucial to minimize the risk of the reported data being misunderstood and manipulated for unscrupulous purposes. When requiring and publishing information as a regulator, we have an obligation to ensure that we do not contribute to the culture of information by unscrupulous actors who seek to sow the seeds of chaos into the financial reporting ecosystem. Although the proposal indicates that some of the metrics are highly contextual measurements, I am concerned that this proposal falls short in providing sufficient context for some of the subjective and complex metrics, such that they may not be useful in decision-making. For example, one of the proposed metrics is the percentage of issuer engagement that use specialists in shared service centers at the firm level, and hours provided by specialists in shared service center at the engagement level. My understanding is that shared service centers are often used on less complex audit matters or routine tasks for efficiency and to reduce overall audit costs. The use of shared service centers also facilitates centralization and standardization, which could enhance audit quality. The proposal acknowledges that the use of shared service centers is a highly contextual measurement, as the use of the work of shared service centers is dependent on the structure and resources of each firm and the specific needs of individual engagement teams. Given that this metric will likely vary across firms and specific engagements, the reported data for this metric is unlikely to indicate higher or lower audit quality without additional context. Similarly, the number of hours worked by specialists may not be a useful metric since the use of specialists is likely to vary based on the specific type of issuer and the unique risks for any one issuer. Without proper context, the comparability among issuers would be limited, as they may not be apples to apples comparisons. Number 3, will the information we are proposing to collect be a good fit for its proposed use? Based on the preamble, the problem this proposal seeks to solve is, quote, investors and audit committees cannot easily observe the services performed by auditors. This can limit investors' ability to make informed decisions about investing their capital, ratifying the selection of auditor, and voting for members of the board of directors, including directors who serve on the audit committee and audit committee's ability to choose among and monitor the performance of auditors. The proposed use is therefore to enable audit committees to efficiently and effectively monitor and select auditors, and to highlight that, quote, investors have an important role, albeit indirect, role overseeing the work of both the auditor and audit committee, unquote. Although well-intentioned, I'm concerned that the staff's premise that audit committees are not efficiently and effectively monitoring and selecting auditors without these metrics might be erroneous. Section 301 of the Sarbanes-Oxley Act of 2002 amended Section 10A of the Securities Exchange Act of 1934 by adding a requirement that, quote, the audit committee of each issuer in its capacity as a committee of the board of directors shall be directly responsible for the appointment, compensation, and oversight of the work of any registered public accounting firm employed by that issuer for the purpose of preparing or issuing an audit report or related work. And each such registered public accounting firm shall report directly to the audit committee, unquote. Under the 34 Act, audit committees have not only bargaining power, but also a contractual relationship with their selected audit firm, and therefore already have access to any information needed to fulfill their statutory responsibilities. The premise that the audit committee somehow needs standardized metrics to aid in its comparison and selection of auditors is simply theoretical. I have been meeting with many audit committee chairs and members, and I have been impressed by their business acumen and their deep expertise in accounting and finance. Most importantly, they are deeply committed to and understand the importance of audit quality. In addition, the proposal notes, quote, shareholder ratification of the appointment of the auditor is not statutorily required in the U.S., and in many cases, the ratification vote is non-binding, unquote. If shareholder ratification votes are for the most part non-binding, it seems that the justification for the proposed collection of information to help shareholders efficiently and effectively ratify the selection of auditors and allocate capital is not a good fit for purpose. In my outreach to investors and audit committees, I understand that it is rare for shareholders to not ratify the audit committee selection. Shareholders rely on audit committees to do their job appropriately, as they have the expertise and regularly engage with the auditor. Are we suggesting that shareholders could make a non-binding decision on auditor ratification based on metrics that we admit do not comprehensively measure audit quality? Are we suggesting that shareholders should engage in direct operational oversight of audit committees and auditors? I certainly hope not, because that will instill chaos into this ecosystem and sow further distrust in the capital markets, contrary to our statutory mission to protect investors. I am therefore concerned that the proposal does not clearly and objectively articulate our goals and how the information we plan to collect fits within our goals. Congress gave the PCAOB broad authority to require registered firms to provide additional information beyond what is statutorily required. However, this authority is not open-ended. Rather, Congress authorized the board to require the submission of such additional information only when the board determines that it is necessary or appropriate in the public interest or for the protection of investors. This authority also comes with the responsibility to be prudent in terms of the reporting burdens we are imposing on firms, because more disclosure does not necessarily mean better disclosure, especially when the additional disclosure is difficult and expensive to prepare and does not meaningfully improve an investor's ability to assess a company's business and operations. PCAOB's mission of investor protection does not operate in isolation from the ultimate goal of investors to earn returns on their investments. Investors need to trust that the PCAOB, as a regulator, will exercise its statutory authority to protect investors in a measured, cost-effective way to help investors accumulate wealth. Inaccurate, unhelpful, and burdensome reporting requirements on firms will ultimately hurt investors' return on their investments. Lastly, the proposal does not articulate clearly what the PCAOB is going to do with all this information. We are proposing to mandate the firms submit this information by their respective due dates. But what are the PCAOB's due dates to publish? Will we analyze the information we collect and share our analysis with the public? We've had a continuous stream of proposed and adopted standards during my short tenure here at the PCAOB. As I stated in my February 27 statement regarding the firm's registration proposal, I'm concerned that we're not mindful of the limited capacity of some of our stakeholders to respond to our ongoing stream of proposals with short comment periods. I'm particularly concerned about smaller firms having the capacity to review the proposals and provide comments. With that said, I value stakeholder insights to help us mitigate the risk of adopting requirements that are costly and ineffectively, as well as the possible unintended consequences that are harmful to investors as well as the capital markets. I look forward to hearing from commenters their insights on the usefulness and feasibility of these proposed metrics as proxies to audit quality. Specifically, I'm interested in hearing from shareholders and audit committees to what extent these metrics would be helpful or harmful to investors. Additionally, I'm broadly interested in hearing about the impact on small and medium firms. In closing, I cautiously support this proposal and encourage all stakeholders to provide comment letters. I would like to express my appreciation to the Office of the Chair, the Office of the Chief Auditor, and the Office of Economic and Risk Analysis for their contribution to the proposal. I now have a few questions for the staff. My first question is, the proposal states, the board has studied ways to measure audit firm and audit engagement performance, primarily with a view to providing information useful to investors in their investment and proxy voting decisions. Based on the said studies performed, how do you anticipate that the average investor will use this information in practice?
Thank you, Board Member Ho. I can take that question. So we have not analyzed in the EA exactly an economic analysis that is what exactly is the average investor. We think that that could be an institutional investor in certain cases based on how you calculate an average investor, could be more of a retail investor depending on how you calculate it. But that said, based on our research, it seems like maybe institutional investors are more likely to use the metrics for the purposes you just described than retail investors are.
Okay, so thank you. And as a follow-up on the proxy voting decisions, footnote 239 states, on average, shareholder votes against ratifying the appointment of the firm are not associated with audit failures, but are associated with investment performance. Based on this footnote, how does this support the conclusion that investors are more likely to challenge auditor ratification, as the votes against appear to be associated with investment performance as opposed to auditor failures?
Okay, thank you very much for the question, Board Member Ho. So throughout the EA, we focus mostly on investors as a single group. But in this footnote that you mentioned, yes, there is a study there that points to this result that maybe maybe investors are not fully informed by actual audit failures that they have observed. And this maybe taken in isolation, maybe casts some doubt on investors' ability to or use information. But so thanks for that. But I did want to highlight a few things, some contextual factors to really fully appreciate this. So we always try to consider all data and academic studies in the economic analyses. We try to have an even-handed analysis, and therefore we didn't, we care about this article and we are informed by it. But in that same footnote, I should say in that article first, that article finds that the result is primarily driven by retail investors. And so that kind of feeds back into my point earlier that we do think that most likely the retail investors will be less likely than maybe the smartest, the biggest institutional investors. And then I'll also point out that there are two other studies in that footnote that look at other proxies. Like one looks at PCAOB censures, and it turns out that that does inform shareholder voting, and also audit tenure disclosures that does inform shareholder voting. So we try to look at all of these studies together to inform our opinion. And I just as a blanket caveat, the proposed metrics are totally new. There are similar information out there, but they would be no, and they're not studied yet. So we have to keep in mind that it to a certain extent, it remains to be seen what exactly will happen with the newest proposals. Perhaps some of the retail investors will actually find them useful due to the fact that they will be more comparable and accessible than information they currently have.
Thank you for that. I appreciate you guys looking across all spectrum. It does sound like there is a wide range of different types of investors, and we perhaps need to evaluate more and understand more of what all the investors are really interested in. I have one last question regarding the audit committees. Given that audit committees already have direct access to auditors and therefore can question and directly engage with the auditors, how do you think these metrics will change the dynamics of the audit committee and auditor interactions?
Thank you for the question. I'll go ahead and take this one. As you say, audit committees have access to their auditor and can ask many questions. One thing that would be new is some of this information might not be tracked or determined by the firm yet, and so in and of itself could provide new information to the audit committee about this engagement team. Having information that's comparable across peer audits in similar companies, we believe audit committees would have additional information to better understand their audit as compared to others, and we think that would trigger a good dialogue. Thank you.
Thank you. Back to you, Chair Williams.
Thank you. Board Member Stein, the floor is yours.
Board Member Stein, I believe you're muted. Thank you, Brian. Thank you. Thank you to the chair for introducing me. Today, we're considering a proposal to require certain audit firms to report 11 performance metrics related to their audit and audit practices. This is a crucial step in a process that began almost 16 years ago. And more importantly, it's a crucial step in increasing transparency for investors, audit committees, and the capital markets overall. As my colleagues have mentioned, in October 2008, the United States Treasury Department had an advisory committee on the auditing profession, known as ACAP, that recommended in its final report that the PCAOB, working with its primary stakeholders, should determine the feasibility of developing key indicators of audit quality and effectiveness and requiring audit firms to publicly disclose those indicators. The committee explained that, quote, a key issue in the public company audit market is what drives competition for audit clients and whether audit quality is the most significant driver. Currently, there is minimal publicly available information regarding indicators of audit quality at individual accounting firms, end quote. So the ACAP's recommendations first led to several years of study by the PCAOB staff. The committee also suggested that the PCAOB work with its stakeholders on these issues. This resulted in the PCAOB engaging with its own investor advisory group in a meeting in 2013 to discuss audit quality indicators. In July 2015, the PCAOB issued its concept release on audit quality indicators. This release suggested 28 possible audit quality indicators, and they were divided into 3 sections: audit professionals, audit process, and audit results. Shortly after the publication of that concept release in November of 2015, the PCAOB Standing Advisory Group held a 2-day public roundtable on that concept release. Ultimately, the staff received and analyzed 50 comment letters. And subsequent to that, our new investor advisory group and our standards and emerging risk group have also held discussions on this topic. So I say all of this because all of this effort was foundational to the proposal before the board today. Today's recommendation from the staff rests on the premise that the proposed metrics will provide information that will strengthen investor protection, promote better informed decisions in the oversight of auditors by their clients, and increase auditor accountability, and ultimately enhance confidence in our public capital markets. And there's a simple reason. It's often said that auditing is a credence good. That is, its operation and its qualities are hard to observe. And I think this is because investors and other stakeholders lack the information available to auditors and the companies they audit about what auditors do and how they do it. That is why the promise of these metrics in generating insights into the way audits are conducted, both within and between audit firms, is substantial. However, I think it's important to understand what the proposed performance metrics are and what they are not. They can provide accurate, standardized, and I would say decision-relevant information that measures aspects of firm and engagement performance. They can aid in assessing an audit firm's readiness and execution, making possible comparisons not only between firms, but also between engagement teams within the same firms. Still, I think as the release makes clear, the metrics do not purport to create a magic formula for assessing audit quality, and for good reason. A sound audit depends first and foremost on some intangible qualities, such as an auditor's independence, their due care, their professional skepticism. The metrics can illuminate the environment that helps foster those critical qualities, but the qualities themselves are hard to measure. The 11 proposed metrics, 8 at both the firm and engagement level, 1 only at the engagement level, and 2 only at the firm level, should provide much greater transparency about what audit firms do and how they do it. And transparency should benefit everyone. As the release points out, a data-driven understanding of the conditions for auditing can benefit audit firms no less than investors and audit committees. It will put everyone on a more equal footing in exercising their responsibilities and understanding the audit environment. So I look forward to receiving comments on today's proposal. I'm particularly interested in the public's views on questions 19 and 20 about the engagement partner metric and whether the time the engagement partner spends on a particular audit should be disclosed. I also hope we will receive thoughtful comments about other potential metrics discussed in the release, such as training, access to technical resources, and investment in audit infrastructure. Given the digital transformation of the audit industry, these are increasingly important subjects. Finally, I cannot close without acknowledging and thanking the entire team that put this project together. I'll say in particular, Jessica Watts, Karen Wiedemann, Stephanie Hunter, Claire Sever, Kiko Upchurch, and Skylar Sims from the Office of the Chief Auditor, Nick Galunik and Jonathan Fluharty-Jady from the Office of Economic and Risk Analysis, and Connor Rasso, Catherine Kelly, Vince Meehan, and Mark Francis from the Office of the General Counsel. I also would like to acknowledge the work of the staff of the board from the old Office of Research and Analysis on this concept release in 2014 and 2015. That helped lay the groundwork for what we're seeing today. So thanks to everyone for all of your hard work, and I look forward to receiving public comment on this thoughtful proposal. Thank you.
Thank you. Board Member Thompson, the floor is yours.
Thank you, Chair Williams. With both of today's proposals, the PCAOB seeks to further transparency in the interest of investor protection. Investors have long expressed concerns around the opacity of the audit. Investors are delivered an audit opinion with limited information as to how the auditor arrived at the conclusion of the audit. Firm engagement metrics help fill the void. If adopted, these metrics will shed light into the conduct of the audit, including the expertise and workload of who was involved, hours spent in areas of risk, and insight into the firm's internal monitoring and partner performance rating processes, which are significant aspects of the firm's systems of quality control. Many firms currently disclose certain firm-level metrics in transparency reports, but today's proposal would improve metric reporting in 2 ways. First, by defining the metrics and the associated calculation. It will drive consistency and comparability across the market. With the new Form FM for reporting on firm-level metrics, stakeholders can easily access this information in a consistent format. Second, the proposal includes a proposed requirement for Form AP to include engagement level metrics. Investors would now be able to horizontally compare metrics across engagements and firms. This is a level of insight not currently available in the market. These metrics, in particular at the engagement level, will bring a new level of transparency, allowing firms to publicly demonstrate the level of audit quality professed to provide. I am in full support of today's proposal because it could substantially increase transparency of the audit process. It has been a long time coming, 16 years to be exact, from the inception of the idea of metrics as mentioned in the 2008 Treasury ACAP report to the PCAOB concept release in 2015, to the PCAOB research agenda in 2022, to today's proposed release in 2024. A significant amount of work has gone into making this a reality. Back in 2016, The PCAOB's Investor Advisory Group listed metrics, formerly known as AQIs, or audit quality indicators, as a method or as a recommended top priority for near-term action. Since that time, the PCAOB has continued to conduct extensive outreach to identify the metrics and information of most interest to stakeholders. Today's proposal is a culmination of extensive internal deliberations and external perspectives received from a variety of stakeholders and experts. This proposal advances our strategic plan objective of having robust dialogue with stakeholders as part of our standard setting process. I look forward to public input on this proposal. I would like to thank the individuals involved in today's proposal, including in the Office of Chief Auditor Barbara Vantage, Jessica Watt, Stephanie Hunter, Karen Wiedemann, Claire Sever, Akiko Upchurch, and Skylar Sims. In the Office of Economic and Risk Analysis, Martin Smaltz, Nick Galanich, and Jonathan Fluthardy Chade. In the Office of General Counsel, Connor Rasso, Catherine Kelly, Vince Meehan, and Mark Francis. I would also like to thank the staff of the SEC Office of Chief Accountant, my fellow board members, their staffs, and my staff. Thank you. I have no further questions or comments.
Thank you. Board Member Bodick, the floor is yours.
Good afternoon, and thank you, Chair Williams. I am pleased to support the firm and engagement metrics proposal before us today. Today's recommendation, as has already been said, has been long in coming. I was a staff member in the Division of Registration Inspections in 2008 when the Treasury's Advisory Committee on Auditing Profession, or ACAP report, first recommended developing indicators of audit quality. And I remember distinctly and vividly the many conversations that ultimately led to our own 2015 concept release on the subject. More recently, our Investor Advisory Group and Standards and Emerging Issues Advisory Group, the IAG and the SEAG, have discussed the topic at multiple meetings and provided valuable input and perspectives. That history, as acknowledged in the release, underscores how strongly investors and other stakeholders have sought this type of information. There have also been developments outside the PCAOB over the years. In particular, as the release notes, other jurisdictions have introduced their own mandatory or voluntary reporting regimes. And whether in reaction to such initiatives or for other reasons, some audit firms have been issuing reports that publicly disclose certain firm-level information for several years. Collectively, this history indicates there is not only clear demand for such information, but also at least some supply is already being provided. These developments may raise several questions. What is our goal in bringing this proposal today? What is the role these requirements play in this environment and their value added? To my mind, the main strengths of the proposal can be boiled down to one concept: a need for increased transparency into the audit process. This means transparency for investors, for audit committee members, and for other users of financial statements. This transparency in turn fuels trust in those financial statements, in their audits, in the auditor, and ultimately in the auditing profession. The proposal identifies 11 metrics that aim to draw back the curtain and offer insight into the work of audit firms. They are designed to aid investors, audit committee members, issuers, and other stakeholders in their decision-making. If adopted, the proposal would require certain audit firms to provide standardized, consistent, and comparable information to the public. Going back to my point a moment ago about demand and supply, this proposal will bring structure, consistency, and a rigor to the efforts that preceded. This is what has been sought for over a decade. This is what cannot be guaranteed by the information currently available, and this is what this proposal endeavors to provide. Those who have followed this project will have noted that during its evolution, we have transitioned from the term audit quality indicators, or AQIs, to firm and engagement metrics. As the release explains, the new term is meant to avoid the potential misimpression that any set of metrics can comprehensively measure audit quality and emphasize our goal of promoting informed decision-making through robust disclosure requirements. I have emphasized before the importance of audit quality as a driving force in the PCAOB's work, as well as its tantamount significance to the auditing profession as a whole. But I agree that for all of its obvious value, audit quality can be difficult to measure, and that no one set of metrics, no matter how carefully articulated, can fully capture it. This change in terminology does not reflect any departure from our commitment to driving audit quality. Rather, it acknowledges that these metrics' potential benefits extend to other areas within our larger mission of investor protection and the public interest. Those benefits will evolve over time. My consideration for this proposal has led me to believe that the ultimate value of many of the proposed metrics would likely be realized over a longer time horizon. Trends across and within both firms and engagements may emerge. Such trends could provide not only information for the acquirers of audit services, but the users of financial statements, but also direction to the academic community about potential research areas, which in turn could provide further insights into the overall audit market and also assist our work. I also have reflected on how these metrics could be used to inform our inspection work and other oversight activities. Reflecting on my tenure as an inspector and director of DRI, this information would benefit and supplement our inspectors' work in numerous ways, including suggesting questions to ask of firms, providing input for our audit file selections, and examining similarities and variability among comparably situated firms and audit engagements. I suspect the uses here will only increase over time. Both levels of the metrics, firm and engagement, are important for all these endeavors. The former are designed to provide insight into the manner in which firms manage and deploy resources, while the latter demonstrate the execution of those efforts on individual audits. The metrics proposed strive to collect information in a meaningful and comparable form. However, as the release acknowledges, a number is only a single data point. I am pleased that the proposal includes a text box for each metric to allow firms the opportunity to provide additional context should they believe it helpful. Taken as a set, I am confident that this information will equip audit committee members to engage in robust discussions with their auditors about the execution of their specific audit and facilitate broader questions about the firm and its ability to perform high-quality audits. Investors have already indicated that they value such information to inform their decision-making. I welcome all comments on all aspects of the proposal. I note here several features of the proposal I would particularly appreciate hearing about. First, the proposal notes several metrics that were seriously considered for inclusion that ultimately were not included. To the extent commenters feel strongly about their inclusion and have ideas on how such metrics could be structured to best provide useful information, please share your thoughts. I am particularly interested in commenters' views on the inclusion of a training metric. Second, the proposal acknowledges that the task of reporting these metrics may weigh heavier on smaller firms. That is why, for instance, the proposal includes both a threshold for required reporting, limiting it to firms that audit accelerated or large accelerated filers, and a scaled approach to implementation where firms that audit 100 or fewer issuers have an extra year before reporting would begin. I ask all stakeholders to weigh in on these dimensions and whether they balance all relevant factors. And I encourage firms especially to share thoughts and possible challenges to complying with these new requirements if they are implemented, particularly if they perceive that different types or sizes of firms may face specific or unique challenges. Reaching this point has been an effort years in the making, and I cannot name all the staff who've contributed to this project's various permutations, but I would like to especially recognize Gregory Jonas, the former director of the Office of Research and Analysis, now the Office of Economic and Risk Analysis, who led the efforts in 2015 that culminated in the concept release. Let me also acknowledge and thank those who've contributed or consulted directly to today's proposal. From the Office of the Chief Auditor, Barb Vantage, Jessica Watts, Karen Wiedemann, Stephanie Hunter, Claire Sever, Akiko Upchurch, and Skylar Sims. From the Office of Economic and Risk Analysis, Martin Schmoles, Nick Gulick, Jonathan Fluharty-Jitty, and from the Office of the General Counsel, Connor Rasso, Catherine Kelly, Vince Meehan, and Mark Francis. Thank you.
Thank you. Unless there are any further discussions from the board, I would now call for a vote on the staff recommendation. Board Member Ho.
I support the recommendation.
Thank you. Board Member Stein.
Aye.
Thank you. Board Member Thompson.
I support the recommendation.
Thank you. Board Member Bodick.
Aye, I support the recommendation.
Thank you. And I also support the recommendation. All votes are unanimous. The recommendation is approved. The next order of business before the board today is a staff recommendation that the board propose for public comment amendments to the reporting requirements for registered firms. To present the staff's recommendation, I will turn to our Office of General Counsel and our General Counsel, James Capoli.
Good afternoon, Chair Williams and board members. The Office of the General Counsel is pleased to recommend that the board issue for public comment a proposal to amend the rules and forms governing the PCAOB's periodic and special reporting framework for registered public accounting firms, and to recommend other enhancements to firm reporting. In furtherance of the PCAOB's investor protection mission, Congress mandated that registered firms submit public annual reports to the board and provided that firms may be required to report more frequently such other information as the rules of the board or the commission shall specify as necessary or appropriate in the public interest or for the protection of investors. To that end, the PCAOB adopted its annual report form, Form 2, and its special report form, Form 3, in 2008. Since that time, the staff has considered its experience with the information elicited by the reporting framework, investor concerns regarding audit firm transparency, the development of voluntary and other audit firm reporting initiatives, academic research, and other developments. Based on this information, we believe that improvements to the reporting requirements should be made to facilitate more public disclosure about aspects of registered firms' operations that could impact firms' ability to conduct quality audits, and that such disclosure would be informative and useful to investors, audit committees, and other stakeholders. Further, enhanced reporting requirements would facilitate the PCAOB's regulatory functions and thus better inform the board's oversight activities to protect investors. In just a moment, I will invite Mark Francis to present an overview of the proposed amendments. Before doing so, I want to recognize several people who made significant contributions to this project. From the Office of the General Counsel, I want to recognize and thank not only Mark, but also Connor Rasso, Catherine Kelly, and Damon Andrews. From the Office of Economic and Risk Analysis, I want to thank Martin Schmalz, John Cook, Dylan Rassier, and Carrie Von Bos for their partnership and support. From the Office of the Chief Auditor, I want to thank Jessica Watts, Lisa Calandriello, Lynette Kleindienst, and David Elam for their assistance. From the Division of Registrations and Inspections, I want to thank Christine Gunia, Tim Sykes, Carol Swaniker, Michael Stevenson, Alan Kerwin, Pamela Robinson, Eugene Theron, Kathleen Ostaszewski, Kevin Taylor, and Abina Glasgow. From the Division of Enforcement and Investigations, I want to thank Kristen Van Fossen, John Abel, Kira Armstrong, Brett Collings, and Tina Bell. I also want to thank the staff from other offices and divisions, including the Office of Communications and Engagement, who have provided assistance with this project. Lastly, I want to thank the Securities and Exchange Commission staff, including the staff of the SEC's Office of the Chief Accountant, for their support and assistance with this project. Mark Francis of the Office of the General Counsel will now provide an overview of the proposal, and then Tien Liang and Dylan Rassier of the Office of Economic and Risk Analysis will provide some additional remarks before Mark closes with our recommendation. Mark, I will now turn it over to you.
Thank you, James, and good afternoon, Chair Williams and board members. I'd like to begin by providing background on the recommended firm reporting proposal before the board, and then an overview of the proposed requirements. Robust disclosure is the cornerstone of the U.S. federal securities regulatory regime and is essential to efficient capital formation and allocation. Access to meaningful information about a public company allows investors to make informed judgments about the company's financial position and the stewardship exercised by the company's directors and management. With the passage of the Sarbanes-Oxley Act of 2002, Congress acknowledged and re-emphasized the auditor's important gatekeeping role within the public company disclosure framework. In the same act, Congress also mandated public annual reporting by audit firms and established the board's authority to require reporting of other information as necessary or appropriate for the public interest or protection of investors. The board's current reporting framework includes two types of reporting obligations. First, it requires each registered firm to provide basic information once a year about the firm and the firm's audit practice over the most recent 12-month period. The firm must do so by filing an annual report on Form 2. Second, upon the occurrence of specified events, a firm must report certain information by filing a special report on Form 3. The proposed changes outlined here today would require enhanced reporting related to firm financial, governance, and network information, more timely and expanded special reporting, new cybersecurity-related reporting, and a one-time update to a firm's statement of applicants' quality control policies and procedures in the event that the board's proposed new quality control standard is adopted and approved. While formulating this recommendation, the Office of the General Counsel took into account the staff's experience with the current reporting framework, the final report of the Department of the Treasury's Advisory Committee on the Auditing Profession, developments in transparency reporting, including increased voluntary transparency reporting and the activities of other regulators, PCAOB advisory group discussions, and increased threats from cybersecurity incidents. After careful consideration, we are recommending that the board propose additional reporting requirements to enhance audit firm transparency and improve the PCAOB's oversight of audit firms. Specifically, the staff believes the proposed changes would improve audit firm reporting in several respects. First, the staff's oversight indicates that quantitative and qualitative aspects of firm structure, resources, and operations could impact the ability of firms to conduct quality audits. And therefore, more public disclosure about registered firms in this regard would facilitate informed decision-making and risk assessment by investors, audit committees, and other stakeholders. Second, more reporting by registered firms would generate data and information to support the PCAOB's regulatory mission. Specifically, it would facilitate monitoring of firms for risks or issues that may affect the ability of firms to conduct quality audits and may potentially affect the broader market for audit services, facilitate analysis and planning related to the PCAOB's inspection program, identify circumstances or events that may warrant or inform enforcement investigations, and inform the PCAOB's standard setting and rulemaking processes. Third, formalizing reporting requirements would make reported information more useful by increasing standardization and comparability. And fourth, by increasing the scope of special reporting and requiring special reports on a shorter time frame, the proposal would get useful information to the PCAOB, investors, audit committees, and other stakeholders more promptly in a manner consistent with today's information environment. Before I briefly describe the key provisions of the proposed changes, I will mention that this proposal is divided between information to be reported publicly and information to be reported confidentially. Under the proposal, certain of the information provided would be reported publicly, namely enhanced fee information, governance and network information, information related to a firm's policies and procedures that are intended to manage cybersecurity risks, and a one-time update to a firm's statement of applicants' quality control policies and procedures. On the other hand, certain other information in this proposal would be provided to the PCAOB confidentially, namely financial statements from the largest firms, special reporting of material events, and cybersecurity incident reporting. In recommending to make certain items public and certain non-public, we have weighed the public interest in public reporting of this information, the potentially sensitive and developing nature of certain information requested, and the board's obligations under the Sarbanes-Oxley Act. And we believe the proposal strikes the appropriate balance between public and non-public reporting. Now I will begin to address in more detail these new disclosure requirements. First, with respect to financial information, the proposal would include two primary components. First, the proposal would amend Form 2 to require enhanced information regarding a firm's audit fees. The annual report form currently requires to report the total fees that were billed to issuer clients for certain categories of services as a percentage of total fees billed. The proposed changes would eliminate the reporting of percentage information and replace it with actual dollar amounts to be reported publicly. The proposed changes would also require a more complete and further disaggregated fee information. Second, the proposal would require that the largest firms provide annual financial statements to the PCAOB on a confidential basis. The large firms would be defined as those that had more than 200 reports issued for issuer audit clients and more than 1,000 personnel during the relevant reporting period. These financial statements would be reported in accordance with the applicable financial reporting framework in the firm's jurisdiction and need not be audited. Next, with respect to governance information, the proposal would require all registered firms to report publicly on Form 2 enhanced information regarding their leadership, legal structure, ownership, and other information, including what processes would govern a change in the form of the organization. With respect to network information, the proposal would require a more detailed description of any network arrangement of which a registered firm is a part, including describing the legal and ownership structure of the network, network-related financial obligations, information sharing arrangements between the network and registered firm, and network governing boards. With special reporting on Form 3, the proposal would shorten the time frame for special reporting from 30 days to 14 days, or more promptly as warranted. In addition, the proposal would impose a new special reporting obligation for any event or matter that poses a material risk or represents a material change to the firm's organization, operations, liquidity or financial resources, or provision of audit services. Such events would include, for example, a determination that there is substantial doubt about the firm's ability to continue as a going concern, any actual or anticipated non-compliance with loan covenants, and a change in a principal executive officer, among other events. Next, I will address the recommended cybersecurity amendments, which have two components. First, we are recommending that the board propose new special reporting requirements for prompt reporting of significant cybersecurity incidents. The proposal would define significant cybersecurity incidents as those that have significantly disrupted or degraded the firm's critical operations, or are reasonably likely to lead to such a disruption or degradation, or those that have led or are reasonably likely to lead to unauthorized access to the information systems of the firm in a way that has resulted in or is reasonably likely to result in substantial harm to the audit firm or third party, such as companies under audit or investors. Specifically, we are recommending that the board revise Form 3 to require the reporting of significant cybersecurity incidents within 5 days on a confidential basis. Second, we are recommending that the board revise Form 2 to request a brief description of the audit firm's policies and procedures, if any, to identify, assess, and manage material risks from cybersecurity threats. This proposed item would instruct the audit firm to include whether and how any such policies and procedures have been integrated into the registrant's overall risk management system or processes, whether the firm engages assessors, consultants, auditors, or other third parties in relation to cybersecurity risks, and whether the firm has policies and procedures to oversee and identify such risks from cybersecurity threats associated with its use of any third-party service provider. Last, we are recommending a reporting-related requirement that has evolved out of the board's QC 1000 proposal. Currently, applicants for registration are required to furnish as an exhibit to the board's Form 1 a narrative summary description of the quality control policies of the applicant for its accounting and auditing practices, a statement of applicants' quality control policies and procedures. We are recommending that the board propose to create a new form, update to the statement of applicants' quality control policies and procedures, Form QCPP, to require that if QC 1000 is adopted by the board, approved by the SEC, and becomes effective, then any firm that registered with the board prior to the date that QC 1000 becomes effective must submit an updated statement of the firm's quality control policies and procedures pursuant to QC 1000. Before I yield the floor to my colleagues in the Office of Economic and Risk Analysis to present their analysis of the proposed reporting requirements, I'd like to first publicly recognize and thank several individuals for their contributions to this recommendation. First, I'd like to thank Chair Williams and her staff, as well as all board members and their staff, for working closely with the Office of the General Counsel to draft the proposal. I'd also like to thank my colleagues in the Office of the General Counsel, specifically James Capoli, Connor Rosso, Catherine Kelly, and Damon Andrews, for their invaluable input and guidance throughout the process in the run-up to this recommendation. I'd also like to thank my colleagues in the Office of Economic and Risk Analysis, specifically Martin Schmalz, Dylan Rassier, John Cook, and Kerry Von Bose, for their insights into the economics of the proposal. I'd further like to thank my colleagues in the Office of the Chief Auditor, Division of Registration and Inspections, and Division of Enforcement and Investigations. And finally, I'd like to thank the Securities and Exchange Commission staff, including the staff in the Office of the Chief Accountant, for their support with this project. And with that, I'll pass the mic to Tian Lang for her team to say a few words about the recommendation.
Thank you, Mark. Good afternoon, Chair Williams and board members. We believe the economic analysis contained in this release even-handedly sets out the likely economic effects of the rule, and we look forward to receiving public input on the release. In particular, relevant data and analysis would be most informative to any future consideration of the proposal. I'll now turn it over to Dylan Rassier, Assistant Director, Economic Analysis, to present the details of our analysis.
Thank you, Tian, and good afternoon, Chair Williams and board members. Investors and audit committees currently encounter a lack of transparency regarding an audit firm's capacity, incentives, and constraints to provide quality audit services. This lack of transparency presents a risk that investors and audit committees will not have decision-useful information in the selection and monitoring of an audit firm. While audit committees are able to request and receive information from firms, the proposed disclosures would be more comparable and accessible than the information audit committees can otherwise gather independently. The proposed firm reporting requirements would enhance transparency of audit firms by mandating public disclosure of firm information that is standardized across firms and over time, and would aid investor and audit committee decision-making. The draft proposal would also require audit firms to report additional specified events and would require the largest firms to confidentially report annual financial statements, which would provide the board with timely information to perform its statutory oversight function. We have analyzed the benefits and costs of the proposed disclosures and confidential reporting. Audit committees would benefit from the enhanced information by being enabled to more efficiently and effectively review and compare information from their incumbent firm with peer firms in their appointment decisions and monitoring efforts. Investors would benefit by being enabled to more efficiently and effectively evaluate and compare firms in their decisions to vote on auditor ratification and allocate capital. Standardization of the proposed disclosures would decrease investors and audit committee search costs and monitoring costs by providing consistent and comparable disclosures across firms and over time. The proposed disclosures and confidential reporting would also enhance the effectiveness of PCAOB statutory oversight, which would benefit investors and firms through more effective allocation of inspection resources, more effective standard setting and rulemaking, and better informed assessments of specified events. Firms would incur infrastructure costs and compliance costs to implement the proposed reporting requirements. Infrastructure costs would include building new or updating existing systems for data collection, reporting processes, controls, and documentation. Compliance costs would include personnel costs to prepare, review, and certify filings. There would also be related costs to train personnel. For those firms subject to confidential reporting of financial statements, compliance costs would include personnel, technology, and processing activities necessary to compile financial statements in accordance with an applicable financial reporting framework. I thank our PCAOB colleagues in the Office of the General Counsel, the Division of Registration and Inspections, and the Division of Enforcement and Investigations, and the SEC staff for their support in developing the economic analysis. I will now turn it back over to Mark Francis to present the staff's recommendation.
In closing, the staff is recommending that the board issue the firm reporting proposal substantially in the form before you and open the public comment period. Thank you.
Thank you, James, Mark, Tian, and Dylon. At this time, my fellow board members and I will have an opportunity to make a statement or ask questions to the staff. We will proceed in the order of seniority, and I will begin. For the second time today, we are taking action to bolster confidence in our capital markets, strengthen oversight and accountability, and empower investors and audit committees with consistent, comparable information. The firm reporting proposal would modernize the PCAOB's framework for collecting information from audit firms by amending the annual and special reporting requirements, which have not been substantially updated since 2008. Today's proposal would facilitate the disclosure of more complete, standardized, and timely information by firms to empower investors and audit committees through greater transparency, while also strengthening the PCAOB's work to protect investors. As with the firm and engagement metrics proposal, many of the proposed changes are changes that were called for in the U.S. Department of Treasury's Advisory Committee on the Auditing Profession Report from 2008, and that have been recommended by the PCAOB's Investor Advisory Group and Standards and Emerging Issues Advisory Group. We have also seen other jurisdictions implementing transparency reporting requirements, as well as firms voluntarily publishing some of the information on their own. Unfortunately, the voluntarily reported information is not complete or comparable. Additionally, our staff's experience tells us that more complete, consistent, comparable information will be useful for the PCAOB's work of protecting investors. The amendments cover 5 key areas. First, financial information. Under the proposal, all registered firms will report actual dollar amounts of various fee categories rather than percentages that are currently required. The new requirements would also provide more disaggregated fee information that is more consistent and easier to compare across firms. Fee reporting would help investors, audit committees, and other stakeholders better understand how a firm's audit practice fits into its overall business and the incentives that may influence resource allocation within the firms. The largest registered firms would also confidentially submit financial statements to the PCAOB. These firms play an essential role in our capital markets and overall economy. Their financial stability impacts their ability to invest in resources necessary to ensure quality audits and to withstand various financial events. Second, audit firm governance information. Firms' leadership and governance have a direct impact on their incentives and ability to provide high-quality audit services investors deserve. Tone at the top and the priorities of firms' leadership strongly influence the level of commitment to audit quality. The proposal will require all registered firms to report additional public information regarding their leadership, legal structure, ownership, and other governance information, including information on the structures and policies that would govern a change in the form of the organization. Third, network information. The proposal would require a more detailed public description of firms' network arrangements, which provide an important window into the accountability and oversight structure the firm is subject to, in addition to the resources the firm has available to devote to high-quality audit work. Fourth, special reporting. Currently, special reporting covers certain events, such as whether a firm is the subject of a lawsuit or regulatory action. The proposal would shorten the time frame for special reporting from 30 days to 14 days, or more promptly as warranted, making certain information available to investors, audit committees, and the PCAOB inspections and investigation staff in a timelier manner. In addition to the existing special reporting requirements, the proposal would add a new confidential special reporting requirement for events material to a firm's organization, operations, liquidity, or financial resources, or provision of audit services. These events have the potential to significantly impact audit quality and investor protection, yet they are not covered under the current standard. For example, the additional requirement might include a determination that there is substantial doubt about a firm's ability to continue as a going concern, or a planned or anticipated acquisition of the firm, changing control, or restructuring. Fifth, cybersecurity. Cybersecurity threats are among the greatest risks to many businesses in today's world, and audit firms are particularly attractive targets. The proposal would require public reporting of a brief description of the firm's policies and procedures, if any, to identify and manage cybersecurity risks, and confidential reporting of significant cybersecurity events to the PCAOB within 5 business days. Together, these provisions strengthen the PCAOB's ability to protect investors while also providing investors with additional data to inform their own decisions and empowering audit committees with consistent data to analyze and compare as they are selecting and monitoring audit firms. I'd like to thank the many members of the PCAOB staff who have worked on this rulemaking project, including from the General Counsel's Office, James Capoli, Connor Rasso, Catherine Kelly, Damon Andrews, and Mark Francis. From the Office of Economic and Risk Analysis, Martin Schmalz and Dylan Rassier. From the Office of the Chief Auditor, Jessica Watts, Lisa Calandrello, Lynette Kleindis, and David Elong. From the Division of Enforcement and Investigations, Kira Armstrong, John Abel, Brett Collings, Tina Bell, and Kristen Van Fossen. And from the Division of Registration and Inspections, Christine Gunier, Tim Sykes, Carol Swanaker, Michael Stevenson, Alan Kerwin, Pamela Robinson, Eugene Tarone, Kathleen Ostaszewski, Kevin Taylor, and Ablina Gaskell. In addition, I would like to express my gratitude to my fellow board members and their staff for their contributions to this project. I would also like to thank the Securities and Exchange Commission staff, including the staff in the SEC's Office of the Chief Accountant, for their support and assistance. I encourage all interested stakeholders to weigh in and look forward to thoroughly reviewing your comments. I will now turn to my fellow board members for any statements they may wish to make or questions they would like to pose to the staff. Board Member Ho, the floor is yours.
Thank you, Chair Williams. The proposal states that the proposed additional reporting requirements are necessary or appropriate in the public interest or for the protection of investors, and if adopted, would enhance firm transparency and improve the PCAOB's oversight of firms. Similar to the firm and engagement metrics proposal, this proposal contains a significant expansion of reporting requirements, except that here there are no clear and direct linkages between the proposed new reporting requirements and audit quality. This proposal focuses on reporting related to registered firms' operations, structures, and financial performance. In some cases, it is not clear to me what PCAOB could or would do with the information we're asking for, other than sharing it with the SEC. For example, the proposal would require the largest firms to provide annual financial statements to the PCAOB. The proposal states that obtaining such information could facilitate the board's regulatory response in the event, for example, special reporting of sovereignty-related events. While the annual submission financial statement will surely be informative, mandating information that we have no authority or ability to do anything about could be reasonably construed as a gross overreach and an abuse of regulatory power. The proposal makes no attempt to be transparent about the PCAOB process and criteria for evaluating the firm's level of financial distress. Monitoring financial stability of a specific marketplace that could impact broader U.S. financial stability is the role of the Financial Stability Oversight Council, in which the PCAOB is not a member. In addition, this proposal contains reporting requirements that appear to overlap with or are duplicative of reporting requirements contained in a different proposal, specifically QC 1000. Under the QC 1000 proposal, firms would be required to report the firm's governance structure related to their system of quality control annually and confidentially. Specifically, by identifying the individuals assigned, one, ultimate responsibility for the firm's QC system as a whole, and two, operational responsibility for the QC system as a whole. This proposal would duplicate the same reporting requirements in proposed Form 2, Item 1.4A and 1.4C, which would require firms to annually identify the principal executive officer of the firm and the executive officers that oversee the firm's audit practice. Unlike proposed QC 1000, this proposal would make this same information public. To make matter worse, Form 2, Item 1.4A and Item 1.4E contain duplicative reporting requirements. Specifically, Item 1.4A would require each firm to identify its principal executive officer. Item 1.4E would require each firm to identify the individuals who have responsibilities under paragraph 11 and 12 of proposed QC 1000. Paragraph 11 specifies that the firm's principal executive officer is ultimately responsible and accountable for the QC system as a whole. As a result, Item 1.4 would needlessly require each firm to identify the same information twice. And if proposed QC 1000 is adopted, this proposal in QC 1000 would require triplicate annual reporting of this same information, twice publicly and once confidentially. I am troubled by the incoherent transparency position we are taking on the same information. This incoherency is also evident in this proposal's annual and public reporting requirement in Form 2, Item 1.4F, that each registered firm provide a description of the firm's independent oversight function, the substance of which mirrors paragraph 28 in proposed QC 1000. I am thus deeply troubled by our blatant disregard of the duplicative, if not triplicative, and excessive reporting burdens we seek to impose, as this proposal quantifies neither the increased reporting requirements nor the estimated reporting and record-keeping costs. By my staff's count, the proposal contains approximately 38 new reporting requirements or elements that are either one-time, annual, or episodic. The proposal appears to be erroneously premised on the assumption that more disclosure by every single registered firm, regardless of size or circumstance, equates to better disclosures for investors and for our oversight function. As of December 31st, 2023, 49% of registered firms covered by this proposal are not providing services subject to PCAOB oversight because these firms have not issued an audit report or play a substantial role in an audit for a public company, broker, or dealer over the past 3 years. These firms are inactive firms, and I'm unclear on the value for investors of more burdensome reporting from these firms when they have never or may never conduct audits subject to PCAOB oversight. Some might argue that if these inactive firms do not wish to be subject to the proposed reporting requirements, then they can withdraw their registration status. Inducing inactive firms, either purposely or inadvertently, to withdraw their registration status has the potential to reduce competition in the audit marketplace, since it will be more difficult for inactive firms to become active and enter the public company audit marketplace if they need to reapply for registration. Furthermore, the proposal would require every previously registered firm to file Form QCPP upon the PCAOB's proposed QC 1000 being adopted by the PCAOB board, being approved by the SEC, and the Form QCPP reporting requirements becoming effective. Every registered firm would then be required to provide a description of the firm's quality control policies and procedures, which must comport with the requirements of QC 1000. Completing Form QCPP is no small task. Even if each of the 11 descriptions is brief, the overall description is likely to be many pages in length. The proposal indicates that the policy rationale for Form QCPP reporting is that it would increase transparency to investors and audit committees, who could then evaluate whether and how firms are addressing QC 1000. This is a baffling justification for inactive firms who are not looking to be selected for an engagement by any audit committee. It is thus an unreasonable policy to require the 49% of all registered firms that are inactive to report on their policies and procedures that conform with QC 1000 via Form QCPP. This proposal makes me wish the PCAOB were a federal agency, where this proposal's reporting and record-keeping requirements would be subject to review by the Office of Management and Budget's Office of Information and Regulatory Affairs under the Paperwork Reduction Act of 1950 as amended. But I know that SOX expressly states that the PCAOB is not an agency or establishment of the United States government, which means that the PCAOB is not subject to the PRA. The PRA is designed to reduce the paperwork burden the federal government imposes on private businesses and citizens, so as to not overwhelm them with unnecessary or duplicative requests for information, and to make sure the data federal agencies collect is accurate, helpful, and a good fit for its proposed use. The PRA is also designed to help prevent federal agencies from imposing excessive burden on private businesses and the public, which include burdening more respondents than necessary. I believe that asking inactive firms to submit Form QCPP is excessive, unnecessary, and not a good fit for its proposed use. Furthermore, as I noted earlier, this proposal quantifies neither the increased reporting and record-keeping requirements nor their estimated costs. This would not be the case if the PCAOB were subject to the PRA, because the PRA requires federal agencies to estimate the burden on the public in complying with record-keeping and/or reporting requirements, where the estimate of the burden includes the value of both the time and the effort to fulfill a collection along with the financial costs. My point is that the PCAOB admirably gives stakeholders notice and an opportunity to comment on this proposal as if we were a federal agency subject to the Administrative Procedure Act, but then less admirably elects not to follow the PRA. I am profoundly worried that the board's apparent zeal to impose in each new proposed standard or rule new burdens on firms without sufficient tailoring and without quantifying the estimated burdens may end up breaking the public company auditing profession's back, particularly for small firms. If we break the profession in the name of investor protection, are we really protecting investors? I also want to mention that I have been reading comment letters on our various proposals, as well as meeting issuers, audit committee members, and other stakeholders to better understand what disclosures actual investors want. One comment letter on a different proposal stood out. This commenter wrote, quote, "More disclosure does not necessarily mean better disclosure, especially when the additional disclosure is difficult and expensive to prepare and does not meaningfully improve an investor's ability to assess a company's business and operations." Unquote. I'm concerned that we may be overstating in this proposal how more is better for investors. For example, the proposal states that aspects of firm structure, resources, and operations would, for example, improve investor confidence in public company audits because it would increase the information available to efficiently and effectively evaluate a firm for ratification. I found this statement stunning because it seems we are trying to fool investors into believing that their votes on auditor ratification are binding when we later state the exact opposite in a footnote in the proposal's economic analysis. This footnote states that shareholders voting on a proposal to ratify the appointment of the audit firm is not statutorily required, and in many cases, the ratification vote is non-binding. By overstating the benefits of increased reporting for investors, we lose credibility and may cause others to reasonably question the effectiveness of the PCAOB. Earlier, we voted on the firm and engagement metrics proposal. I have already expressed my concerns about some of the burdensome reporting requirements in my earlier statement. This proposal would add yet another set of overly broad and unduly burdensome reporting requirements. Additionally, the QC 1000 proposal, which was voted on by the board 18 months ago, would require an extraordinary amount of record keeping by registered firms. Since then, we have issued 5 additional proposals, not including the 2 today. While it is important for us to work as fast as we can, it is imperative that we do so responsibly and not act in haste. Standard setting and rulemaking require a careful and thoughtful deliberative process because our capital markets can be fragile, and rushing burdensome, complex, and consequential rules and standards without quantifying the burdens on affected stakeholders could damage the long-term stability of our capital markets. It is therefore crucial to consider the interconnectedness of these proposed standards and rules, as well as the cumulative impact of their burdens on stakeholders, especially with regard to QC 1000, firm and engagement metrics, and firm reporting. Because I believe this proposal represents an overreach of regulatory power and stands to undermine competition in the audit marketplace, as well as investor protection, I dissent. I would like to thank the staff in the Office of the Chair, the Office of the General Counsel, and the Office of Economic and Risk Analysis for their hard work in getting this proposal completed in the midst of many other priorities. I now have a few questions for the staff. First, staff commendably developed and applied a 3-part test to narrowly tailor the financial statement reporting requirement to only the largest firms. Was this 3-part test or some variation used elsewhere to narrowly tailor firm reporting requirements?
Thank you, Board Member Ho, for the question. We appreciate it. I think you're referring in the release to the 3 factors that are discussed and weighed in connection with the recommendation to limit the financial statements to the largest firms.
Yes.
Those factors are the significance of the larger firms to the overall audit market, the potentially outsized consequences of such a firm exiting the market, and costs to smaller firms of preparing full financial statements relative to the benefit of providing that information. For reasons discussed more fully in the release, we think the proposed financial statement requirement is appropriately tailored to this group of firms, so we welcome feedback from commenters. With respect to other firm reporting requirements, the release weighs the costs and benefits of those requirements. We similarly believe the proposed requirements are appropriately tailored and look forward to feedback should the board vote to issue the proposal.
Okay, well, thank you. What impact do you think these requirements will have on the concentration of the audit marketplace? To what extent have the proposed reporting requirements been informed by the economic analysis, especially concerning the unintended consequences acknowledged in the economic analysis to the small and medium-sized firms?
Thank you for your question, Board Member Ho. In our economic analysis, we outline potential competitive effects that may result from the disclosure of additional information and how those effects may differ between larger and smaller firms. But we also acknowledge that competition may give rise to distributional consequences. In particular, firms that are less able to compete could lose market share, be forced to lower audit fees, or potentially exit the market. And these effects could fall disproportionately on smaller firms. We don't think that the scope of the competitive effects that we describe could result from the reporting of the additional information is so significant as to fundamentally change the degree of concentration in the market today. The staff did take under consideration the economic analysis in their recommendations regarding the disclosures. As an example of that, the scope of the financial statement requirements discussed earlier were informed by the economic analysis.
Yeah, so I appreciate you guys, taking a balanced approach and outline the unintended consequences. And you noted in your economic analysis that to the extent that the remaining firms, that the reduction of the competition can be mitigated by the remaining firms expand their market share by acquiring additional capacity from the exiting firms. Can you explain how a smaller number of firms with a greater market share mitigates a reduction in competition? Just a follow-up to your answer.
Yeah, so there could be varying impacts across different segments of the market. So a smaller firm segment, which may be more impacted by this proposal as we outlined in the economic analysis, includes a higher number of firms. And so the impact on concentration may be less noticeable for those firms, even though that they are taking up capacity for those firms that may be exiting the market.
Okay. In the economic analysis that states that the staff consider quantifying the compliance burdens under the PRA, and that it specifically considers surveying firms. Did you conduct any such survey to quantify the burden?
So thank you for the question again, Board Member Ho. We'd like to clarify that we considered using a methodology similar to the methodology used under the Paperwork Reduction Act to calculate compliance burden, but the analysis would not be subject to PRA, as you've also noted. We explain in the economic analysis that we currently lack information about firms' current compliance burdens with respect to Form 2 and Form 3 to assess how those burdens might change under the draft proposal. We decided to add a question to inquire whether commenters could provide any data regarding burden hours to complete Form 2 and Form 3. And we anticipate that this could include firms providing information based on their own experiences. The responses may include firms' actual burden hours to complete the current Form 2 and Form 3, or may include firms' anticipated burden hours to complete the proposed requirements on Form 2 and Form 3 in the future. We couldn't conduct a prospective survey about the changes in compliance burden because that would have entailed a disclosure of the draft proposal. And now that the proposal is being considered for vote by the board today, we welcome the firm's quantitative input as to their expected compliance burden.
Thank you for your response. I have no more questions. Back to you, Chair Williams.
Thank you. Board Member Stein, the floor is yours.
Thank you, Chair Williams. The second proposed rule we're considering this afternoon complements the first, and it's appropriate they're being presented at the same meeting. The metrics release that we've already voted on focuses primarily on the way audits are conducted, while the firm reporting release focuses on, I would say, enhancing the quality and the type of information reported to the board so that it can better understand structural conditions that may affect the firm's ability to perform quality audits. Both proposals stem from the recommendations of the U.S. Department of the Treasury Advisory Committee on the Auditing Profession. And as the proposing release notes, the Advisory Committee recommended enhanced firm reporting and monitoring by the PCAOB and the need to understand the risk confronting audit firms. The ACAP also recommended annual firm transparency reports, and it called for larger audit firms to file copies of their financial statements with the board. All of this because of the critical role audit firms, especially the major firms, play in the integrity and the efficiency of the capital markets. I think it's worth noting that the advisory committee was composed primarily of people with substantial experience in business and the capital markets. One of its two chairs was Donald Nicolaisen, a former SEC chief accountant and senior PricewaterhouseCoopers partner. The other was Arthur Levitt, a former SEC chair and Wall Street veteran. So today's proposal is an enhancement of the existing PCAOB reporting requirements on the firm's annual report, we call it Form 2, and the reporting of certain events that could impact a firm's operations, Form 3. It reflects the judgment of the staff after some years of experience that additional information is necessary to allow the public to understand the foundation by which audit firms provide for audit engagements and to allow the PCAOB to meet its responsibilities under the Sarbanes-Oxley Act. Each of the reporting categories discussed in the release meets that standard. Enhanced financial reporting, more detailed information about firm governance and network structure, and reporting of firm policies and procedures to manage cybersecurity risks. All are issues that investors, audit committees, and others in the financial markets can use to better understand and evaluate their auditor and the audit process. The information sought by the proposal would also boost the board's effectiveness significantly and is necessary for the performance of its mission. Monitoring audit firms, especially large firms, means understanding their structure and their finances. Planning inspections, shaping standards, and targeting enforcement all depend on knowledge of the audit firms involved, not merely of individual audits. So before I close, I want to acknowledge and thank the team that put this extremely thoughtful release together. In particular, from the Office of General Counsel, Connor Rasso, Catherine Kelly, Damon Andrews, and Mark Francis. From the Office of Economic and Risk Analysis, John Cook, Dylan Rassler, and Carrie Von Bose. I also want to thank the other staff members from the Office of the Chief Auditor, our Division of Registration and Inspections, and the Division of Enforcement and Investigations who are actively involved in helping with this recommendation. I look forward to receiving public comment on this proposal. Thank you.
Thank you. Board Member Thompson, the floor is yours.
Thank you, Chair Williams, and I will actually start by saying I support seeking public comment on the proposed enhancements to audit firm reporting requirements. The current reporting regimen has been in place for well over a decade. Over time, our regulatory observations suggest that we may be able to drive audit quality by requiring greater and standardized transparency from registered firms. The firm reporting proposal is made in contemplation of a number of factors, including data obtained through PCAOB oversight activities, developments in firm practice and culture, modern technological realities, including the prevalence of nefarious cybersecurity incidents, and the lack of standardization in current transparency reporting by audit firms. The proposed enhancements to reporting requirements, if adopted, could potentially yield significant benefits. For example, by requiring standardized financial, governance, and firm network information, the PCAOB may be able to effectively monitor registered firms. Indeed, we may be able to engage with them about potential risk of fissures that could impair audit quality or that could potentially cause disruptions in the capital market. The importance of this monitoring function cannot be overstated, particularly considering that the aggregate market capitalization of issuers audited by just the annual inspected firms identified on the PCAOB website exceeds $50 trillion. Through our inspections and enforcement programs, we continue to observe the cascading impact of the tone at the top. In that regard, if we can better understand how firms are governed, we can better assess whether there are frameworks in place that support and emphasize audit quality from one engagement to the next. Another potential benefit from this proposal is that investors and other stakeholders, including audit committees, will have more information to consider in their evaluation of firms. This is particularly important in the common public company process that leads to the appointment of an audit firm and then shareholder vote on ratification of such appointment. Under the proposal, elements of the information that will be solicited are already publicly disclosed by firms in voluntary transparency reports or in transparency reports required by other regulators. There are, however, some disclosure elements in the proposal that would garner highly sensitive information, including financial statements of the largest registered firms. To balance our oversight function and the public interest in disclosure, this proposal has been thoughtfully crafted to limit the disclosure of such sensitive information to the board only. We are cognizant that in certain limited contexts, public disclosure may not be appropriate. In closing, my hope is that greater and more immediate transparency reporting will lead to more effective oversight, and that more effective oversight will advance investor protection. It goes without saying that our rulemaking and standard setting function is strengthened when we garner perspective and insights from various stakeholders. Thus, as we strive to appropriately calibrate firm reporting disclosure requirements, public input is essential. With those considerations in mind, Chair Williams, I reiterate my support for issuing the firm reporting proposal for public comment. Before I conclude, though, I would like to acknowledge the dedicated staff from our various divisions and offices who contributed to this proposal. First, my thanks to the staff from the Office of General Counsel, including James Capoli, Connor Rasso, Catherine Kelly, Damon Andrews, and Mark Francis. From the Office of Economic and Risk Analysis, I would like to thank Martin Schmaltz and Dylan Razier. From the Office of Chief Auditor, many thanks to Jessica Watts, Lisa Caladrillo, Lynette Klindist, and David Elam. From the Division of Enforcement Investigations, I would like to thank Christine Van Vossen, John Abel, Cara Armstrong, Brett Collins, and Tina Bell. From the Division of Registration and Inspection, many thanks to Christine Gunier, Tim Sykes, Carol Swaniker, Michael Stevenson, Alan Kerwin, Pamela Robinson, Eugene Theron, and Kathleen Ostachevsky, Kevin Taylor, and Vina Glasgow. In addition, I'd like to thank my fellow board members and my staff for their efforts in this project. And finally, my thanks again to the staff of the SEC's Office of Chief Accountant for their engagement and support on this proposal. I have no further comments or questions. Thank you.
Thank you. Board Member Bodick, the floor is yours.
Good afternoon, and thank you again, Chair Williams. I am pleased to support the firm reporting proposal before us today. Audit firms serve a critical role in our capital markets. They act as public stewards in a gatekeeping role to protect investors and provide trust within the public company reporting framework. As a result, information concerning firms' ability to conduct quality audits is of paramount importance. Investors, audit committee members, and issuers use this information to inform their assessments and related decisions. And we ourselves use it to perform our oversight activities in pursuit of the public interest. The proposal's focus is enhancing firms' disclosures of this type of information by requiring new or additional information about firms' governance, finances, and to the extent applicable, network information, as well as more timely and detailed reporting on certain events. This proposal strives to improve our view into firms' operations. And to the extent permissible, we would make that information available on our website for the benefit of investors and other stakeholders. The PCAOB was established in response to a series of events that caused investors to question financial reporting and the audit itself. It was abundantly clear to those of us at the time that the auditing profession was thrust into a crisis. It is not surprising then that concerns over audit firm health and viability remain a priority for us and a focus of all our oversight activities. While thankfully, we have not experienced events similar to those of the early 2000s, today we do find ourselves in a rapidly evolving and challenging auditing environment. In addition to wider geopolitical and economic events that require new responses and approaches, we are seeing transformation in firm governance and structure, including, but not limited to, investments from private equity. Against this backdrop, the need for high-quality audits, independence, and a vibrant audit ecosystem has never been greater. We and others in that ecosystem all have a role to play. The information in this proposal supports these goals. As I noted in connection with the proposal for firm and engagement metrics, we endeavor to issue standards and rules that promote transparency. However, such transparency must be weighed against the risk of disclosing certain types of information, as well as our own statutory obligations. Some of the information in this proposal, financial statements and certain material events, and cybersecurity incident reporting, will be collected on a confidential basis. The proposal notes that staff has weighed the potentially sensitive and developing nature of this information requested and the board's obligations under Sarbanes-Oxley. I encourage commenters to offer thoughts, particularly if there are other factors to consider in this assessment. While this information would not be available to the public, it would be used to inform the PCAOB's own oversight activities. Before stepping into my current role as a board member, I spent many years in our Division of Registration and Inspections, so I recognize the particular value of such information to our inspections program. It would offer guidance not only on areas to monitor or inquire after for a specific firm, but also identify wider concerns within specific sectors that merit additional attention. Indeed, many of the details of this proposal derive from previous staff experiences with the existing reporting requirements for 2008. As part of our ongoing oversight activities, we have received important information about firms' operations on a voluntary ad hoc basis in which firms may call and alert various PCAOB staff of pending matters or firm actions. Having been the recipient of many of these voluntary calls, I can confirm how helpful this information was. It allowed the staff to be more informed and to be able to respond and ask further probing questions and perform other oversight procedures as warranted. This proposal takes the insights gained from those interactions and standardizes them to allow for comparable and timely collection that will facilitate access and efficient sharing with offices and staff across the PCAOB. I mentioned earlier that we all have a role to play in the auditing ecosystem to identify and respond to risks and ensure its continued vibrancy. That is why I support issuing this proposal, and why I also welcome and encourage comments from all stakeholders on it. No voice is too small for us to consider. I note a few specific features that I would be particularly appreciative of comments on. First, the proposal requires the filing of financial statements on a confidential basis from firms with over 200 audit reports for issuers and over 1,000 staff, explaining that we weighed this subset of firms' significance to the overall market against the cost of such statements. Do commenters have thoughts on the proposed scope of this requirement or the nature of financial statements required? Do commenters believe that this requirement should extend to all annually inspected firms? Second, the proposal includes several changes to Form 3's reporting requirements. It would revise the reporting deadlines from the current 30 days to 14 days or more promptly as warranted, and it would add a general special reporting obligation for certain material risks or changes. Again, do these proposed changes strike an appropriate balance between the need for this information and the burden imposed on firms? And are the proposed requirements clear? I echo my fellow board members' appreciation to each of the proposal's contributors. To avoid repetition, I will extend my general thanks to the staff of the Office of the General Counsel, the Office of Economic and Risk Analysis, the Office of the Chief Auditor, the Division of Enforcement and Investigations, and the Division of Registration and Inspections for all their hard work on this proposal. I'm particularly appreciative of the time they spent answering my questions on the proposal. Thank you.
Thank you. Unless there are any further discussions from the board, I would now call for a vote on the staff recommendation. Board Member Ho.
I oppose.
Board Member Stein.
I support the proposal.
Board Member Thompson.
I support the proposal.
Board Member Bodick.
I support the proposal.
I also support the proposal. The recommendation is approved with Board Member Ho dissenting. That concludes the PCAOB's open meeting for today. As there is no further business, this meeting is now adjourned. Thank you for your participation. You may now disconnect from the webcast and teleconference.